This LOS is describe the components of the income statement and alternative presentation formats of that statement. The income statement presents information on the financial results of a company's business activities over a period of time. The income statement communicates how much revenue the company generated during a period and what costs it incurred in connection with generating that revenue. That's the matching principle. The basic equation underlying the income statement, ignoring gains and losses, is revenue minus expenses equals net income. The income statement is also sometimes referred to as the statement of operations, statement of earnings, or profit and loss P&L statement. Now this is with regards to the alternative presentation. Under IFRS, the income statement may be presented as a separate statement followed by a statement of comprehensive income that begins with the profit or loss from the income statement, or as a section of a single statement of comprehensive income. So that's the two different presentation formats that are available. U.S. generally accepted accounting principles, U.S. GAAP, permit the same alternative presentation formats. This reading and the following LOSs focus on the income statement, but also discuss comprehensive income. Equity analysts are interested in the income statement because equity markets often reward relatively high or low earnings growth companies with above average or below average valuations, respectively, and because inputs into valuation models often include estimates of earnings. Fixed income analysts examine the components of income statements, past and projected, for information on companies' abilities to make promised payments on their debt over the course of the business cycle. Corporate financial announcements frequently emphasize information reported in income statements, particularly earnings, more than information reported in other financial statements. Components and format of the income statement. The first thing that we're going to look at is when a company is doing consolidation. Consolidation means that companies include all of the revenues and expense of subsidiaries even if they own less than 100%. Minority interest represents the portion of income that belongs to minority shareholders of the consolidated subsidiaries as opposed to the parent company itself. So here's an example from the CFA Level 1 income statement, and it's for the company Danone, okay? So we can see here in 2009, the net income was 1,521 in millions, and 1361 was attributable to the shareholders of Group Danone, and 160 is attributable to the minority shareholders. So that's the first thing that we're looking at with regards to the components and format of the income statement, is that when there's consolidation, you need to look at not only the net income, but what portion is attributable to the group, to the shareholders of the company, and which is attributable to minority shareholders, that is the portion that belongs to somebody else of the consolidated subsidiary. Now we're going to go through the same income statement for Danone, but we're going to go through line by line, and we're going to see exactly where some items fit in the income statement. It's very important to have a strong understanding of where certain items fit in with regards to the ordering. So the first thing to understand, we start with our top line. We often call that the top line of the income statement, and that's our net revenue. That's easy to understand. And most students, candidates understand sales minus cost of goods sold, minus selling, general, and admin. Research and development fits in here as well. That's important to understand that that is part of operating income. And then we have other revenue or expense. So I just made a note here on the right-hand side. Under U.S. GAAP, you can have unusual or infrequent items, not under IFRS, okay? But they're still part of normal operating activities. So what is an example? An example is the gain or loss on disposal of a fixed asset. So you have a piece of equipment, you've sold it, you've incurred a loss. That gain or loss on the disposal of a fixed asset is an unusual or infrequent. It's not unusual and infrequent. Under U.S. GAAP, if it's unusual and infrequent, it would be an extraordinary item, okay? Which we don't have under IFRS. So that's a little bit of a difference between IFRS and U.S. GAAP. I just thought that I would put that in here. Just remind you that under U.S. GAAP, if the company's following U.S. GAAP, gains or losses of equipment are part of operating income. So we have operating income, and then other operating income or expenses, which could be some one-time items. And finally, we have our operating income, okay? That is often called EBIT, earnings before interest and taxes, because what comes below, you can see the first items below is interest revenue and expenses. So I've written here, interest expense is the result of financing activities and would be classified as non-operating expense by non-financial service companies. So that's very important to understand, is that interest revenue or expenses is not included in operating income. It's below operating income. And then we have the cost of net debt. Again, that's a financing decision, so it's not part of operating. And then the last item here, it says other financial revenue or expense. So I've written here the realized, not unrealized, the realized loss on sale of available for sale securities is an investing activity and would also be classified as a non-operating gain or loss by a manufacturing company. So those are some of the items that come below EBIT, interest and expenses, and other financial revenue or expenses. Now you can see I've got my earnings before tax, EBT, or here it's written as income before tax, income tax. And then we have our income from fully consolidated companies. The previous slide was talking about that. And we have our share of profits of associates. So we might have some associate companies that we're not consolidating. This is where we put our share of profits from them. So we have our net income from continuing operations, okay? Now below that is important to note that there's net income from discontinued operations. If it's discontinued operations, then that's going to be net of tax, okay? That's where it fits in. Income from discontinued operations falls below the income from continued operations, and it's reported net of tax. So finally, again, if we look at 2009 for Danone, they had a net income of $15.21. Oops, I did a little bit, the circle's a bit big. $15.21, and $13.61 was attributable to the group, but $1.60 was the minority shareholders, because this is a consolidation of a number of subsidiaries. But in some of those subsidiaries, or one of those subsidiaries, the company doesn't own, Group Danone doesn't own 100%. So this $1.60 is the portion of the net income that's been consolidated that belongs to another company. And that's the last slide for this LOS. Thank you.